What's up, everyone? My name is Ale. Welcome back to my world of stocks. So in today's video, we're going to be talking about ETFs. These are exchange traded funds. And if you're not too familiar with them, what they basically are is a group of stocks that is collected together into a single investment. And so it's kind of like buying one stock that represents many other stocks, in some cases, hundreds of different stocks. And so it's a great way of diversifying your portfolio without having to do so much individual research on every single stock. You can just buy an ETF, it'll represent many stocks and gives you broad exposure to the market. It's a great way of diversifying your portfolio. Now, I'm personally not that big on ETFs myself, just because I actually do really enjoy picking and choosing every single stock in my portfolio. But even then, I realistically can't get the same kind of diversification that maybe some other people can by also adding in some ETFs, just because that does represent such a gigantic amount of stocks, whereas my portfolio is going to be much smaller in terms of the sheer number of stocks. Anyway, ETFs are cool. I think they're pretty fun. And I actually do own an ETF myself, but more on that a little bit later. In today's video, I want to talk to you guys about 3 of my absolute favorite ETFs that if I had to invest in ETFs very long term and buy and hold them well into retirement and even beyond, these are the ones that I really like for the long term. And to make things more interesting in this video, I specifically chose one dividend focused ETF, which is the ETF that I actually own myself. I also chose a balanced ETF with very good stability, but also very solid growth. And then I also chose one speculative ETF that is a little more risky, but it also has more reward potential. So it's going to be a lot of fun. We're going to list these my three favorite ETFs in this video. I hope you guys enjoy it. Hit the like button if you do. But let's go ahead and we'll start with the dividend ETF, which is the one that I do own myself. And that is, of course, the Vanguard High Dividend Yield ETF, ticker symbol VYM, which is an ETF that I am currently up close to 30% on. And I've actually built this up into a pretty large position in my portfolio. I think it's currently like my 5th or number 6 largest in terms of size, but overall it's a fairly good performing ETF, up about 45% in the past 5 years, and the only times that it really drops heavy is when the overall market dips like it did in 2020. But that is not something to be feared. This is an ETF that you can pretty much buy whenever you want, collect the dividend over that time, and then as soon as the market drops and it drags down the ETF, go ahead and buy a lot heavier on that drop, and then you'll end up with an even larger dividend yield to collect well into the future. Because even at these higher levels where it's now trading near an all-time high, VYM is still yielding close to 3%, and on my personal cost basis, because I was able to buy so heavy when it was down, my dividend yield is actually above 3.6%, which I think is fantastic. And overall, I just really love everything about them. First of all, they don't own any real estate investment trust, which other high dividend yield ETFs tend to rely on for their dividends. But the reason why I avoid those is because they can sometimes be a bit more risky, especially with the whole retail apocalypse going on and the rise of remote work. That means less office space being needed. So I'd just rather have an ETF that avoids those altogether. And on top of that, they also own very little oil and gas, which is another sector that I tend to stay away from, just because I think that renewables will most likely be the future as oil and gas gets kind of slowly phased out over time. They do, however, have heavy exposure to financials, which I'm personally not a big fan of at over 22%. I just think that's too high for a single sector that is so heavily reliant on the economy, which has been a bit shady in my opinion recently. But the good news here is that they do at least balance it out with double-digit percentages in consumer non-cyclical, healthcare, and technology, which I'm all much more bullish on long term. The other thing I like about VYM is that their 10 largest stocks only make up less than a quarter of the entire ETF, meaning that it's pretty well diversified across hundreds of different stocks. And even the largest bank is actually JP Morgan Chase, which is at least my favorite bank in the market and one that I actually own myself individually. On top of that, though, you also have some really fantastic dividend stocks in here like Johnson and Johnson, Home Depot, Procter and Gamble, Pfizer, Verizon, and even if you dig a little deeper, you've still got Coca-Cola, Pepsi, Intel, AbbVie, Walmart, Merck, McDonald's. I mean, a lot of those are super reliable dividend stocks for the long term. And that list really just kind of goes on and on with over 400 different stocks in the ETF. So I just think that when you combine the solid yield with the well diversified portfolio and you package all of that together for just a 0.06% expense ratio, which are the small fees that ETFs charge for managing the portfolio, this really ends up looking like one of the best and cheapest dividend focused ETFs in the market. And it's one that I do really enjoy owning long term myself. Okay, moving on to ETF number 2, that'll be my more balanced pick that I feel a portfolio can really be built around just because it comprises some really solid growth, but from more reliable and stable giant companies that also helps limit the risk that you would typically experience from that higher growth. And that ETF is going to be the Vanguard Growth ETF, ticker symbol VUG. And as the name implies, this is an ETF that follows a large cap growth index and it tries to invest in those same stocks at similar percentages. And not only does it have a lower expense ratio than the previous VYM ETF that we just talked about at just 0.04%, but it also has a better distribution across sectors, at least in my opinion, which you'll recall I wasn't too happy about VYM relying so heavily on financials, but VUG, on the other hand, actually has very little exposure to financials at less than 4%. So kind of a good balance there in terms of like if you were to own both. And on top of that, I don't believe they have any exposure to oil and gas or rates either, real estate investment trusts. So that's fantastic as well. Instead, they have close to 60% just in technology alone, which I know a lot of you might see this as too risky, but if you followed my channel for a long time, then you know that I not only love investing in tech, but it's also the sector that I feel will experience the most growth over the long term. So I'm very bullish on tech, and I do not mind an ETF having very high exposure to it and really the most exposure out of all the sectors. In fact, I actually see that as an overall positive, not a negative. Now, I do, however, think that the 20% in consumer cyclicals is a little high, and the 8% in healthcare is probably a little low, but overall, it's not too bad, especially when you look at the stocks that make up the ETF. Speaking of which, VUG does have over 100 less stocks than VYM, but those stock choices are very solid in my opinion. First of all, the top 10 holdings make up close to half of the entire ETF, which is about double the exposure that VYM had, so maybe a little less diverse there. But these 10 stocks are some of my absolute favorite stocks in the entire market, and pretty much all of them I think are solid core foundational stock choices as well. You're talking over 10% in Apple, which is a great overall stock with a super sticky business and unbelievable amounts of cash. About 10% in Microsoft, which is my number one largest stock in my portfolio, and it's my absolute favorite of any stock in the entire market. About 6.5% in Amazon, which is the biggest player in e-commerce and cloud computing. It's also my third largest stock as well. Almost 4% in Facebook, probably the biggest play on social media with a gigantic pool of users and one of the best balance sheets in the world. Over 7% in Google. When you combine the two classes, that's a stock that I really need to start buying myself. It's just one of the most obvious kind of long-term plays for pure dominance in technology and especially internet technology. You've got over 2% in both Tesla and Nvidia, which are two of my absolute favorite plays on EVs, autonomous driving, and so much more in tech. And then over 1% in both Visa and Home Depot, which have always been very solid and reliable choices for practically any portfolio type. Again, those make up the vast majority of the ETF, but even if you look at the rest of their stocks, you also get some other really popular choices as well, like Disney, Netflix, Salesforce, McDonald's, Intuit, Starbucks, Moderna, Square, and the list just goes on and on. And by the way, VUG even pays a dividend too. Now, that's not their primary focus, and it really depends on the companies that they own at a given time, but even at just around 0.5%, it not only easily covers your expense ratio, but it's also just a nice little bonus on top of the already solid performance that you're getting from the ETF overall itself. Speaking of which, in just over the past 5 years, it has already soared by over 160%, whereas our dividend focused ETF VYM only grew by around 45%, and the S&P 500 only grew by about 100% as well. So VUG has outperformed both of those and by a very large amount. Still, I think the best time to buy an ETF like this is when the broader market drops, just because they have so many giant corporations that are kind of hard to bring down outside of a market correction. So you won't typically see too many dips, unless there is kind of a broader market wide drop. But if you ever do see a dip on this one, even really a small one, I think this is definitely one of those ETFs that you're going to want to buy pretty heavy as it drops, and then just kind of keep adding to it over time as you hold it very long term. All right, guys, that's going to bring us now to the third and final ETF of the video. And this is also going to be our more risky and more speculative ETF, but one that also I feel has more reward potential in terms of growth. And for that type of ETF, I would personally go with one of the ARK Invest actively managed funds, which, by the way, is the company headed by the infamous Tesla bull Cathie Wood, who I'm personally a big fan of myself. And there's really a number of great choices here to bet on long term, as they all focus on various future growth markets in technology that I think will be huge in the future. Like, for example, they have the autonomous and robotics ETF, they have the genomics ETF, they have their space exploration ETF, they have their fintech one, their next generation internet one. All of these I think are super interesting. But just to keep things simple, we will go with their flagship, largest, and most popular ETF. And that one is, of course, the ARK Innovation ETF, ticker symbol ARKK. And I'd like to specifically draw attention here to the fact that this is an actively managed ETF, which, if you were to ask me what is like my favorite thing about this ETF, I would probably say that it's the fact that Cathie Wood and her team are frequently making adjustments to the portfolio depending on what their research shows and where they think there will be the most growth in the future. And all the meanwhile maintaining an optimistic long-term view of the market, which is very similar to how I personally feel about stocks and kind of my investing philosophy. So I really do think that, like, when you look at her strategy, she's not afraid to cash in profits, but more importantly, she's not afraid to add on any bad performing stocks as long as she and her team still believe in them long term, because that's going to lower the cost basis, and it's also going to maximize the potential gains, which is exactly what we see happening in ARK's performance. I mean, over the past 5 years, ARK has absolutely skyrocketed by over 400% in gains, easily eclipsing all other ETFs on today's list, as well as the three major indices in the S&P 500, the tech-heavy NASDAQ, and the Dow Jones Industrial. By the way, if you want a deeper dive into the 10 largest holdings of this ETF, I highly recommend my Cathie Wood stock portfolio review video, where I even rank them from best to worst. But just to quickly run through them here, you've got really heavy exposure to those top 10 stocks at over 50% of the ETF, with Tesla at number one, which I love since I think there'll be a huge play on EVs, autonomy, and solar energy and storage. It's actually my second largest stock in my own portfolio. You've got Teladoc Health at number two, which I think is a great play on the future of telemedicine. And it's a stock that I've actually started buying myself too, because it's been falling a lot. I think they have huge potential. You've got crypto exposure in Coinbase. You've got video streaming in Roku. You've got gaming in Unity. You've got video conferencing and remote work in Zoom. You've got digital payments and online shopping in Square and Shopify. You've got music streaming in Spotify, and you've even got cloud-based communications in Twilio. All of these are markets that will very likely grow much larger in the future. And if you dig even deeper, you've got what I think are some other really great stocks for future markets as well. I mean, you've got Zillow, you've got Palantir. I really love Palantir. I mean, I've been buying that one a lot myself. You've also got CRISPR, you've got Intelia, you've got DraftKings, DocuSign, Robinhood, Nintendo. There's a lot of really interesting stocks there. Granted, it does have a higher expense ratio than the others, but that's usually the case with a high profile actively managed fund anyway. And even then, it usually gets more than offset by the special dividends, so I wouldn't even really worry about it. Again, it doesn't have to be this ARK ETF specifically, but I think just speculating on at least one ARK ETF long term will probably show some good success. And if I was more into ETFs myself, I'd probably be betting on at least one of these two, probably this one. Anyway, that does it for today's video. Let me know what you guys think about these ETFs. Are there any ETFs that you guys like? Maybe some that you'd like me to review or talk about in a future video? Let me know that down below in the comments section. I hope you guys enjoyed the video. Hope you're all doing well. I'll see you guys in the next one. Take care. Bye-bye.